The S&P 500 is down 16% year to date. And some people are now saying that the decline is overdone and stocks are cheap, so it's time to start buying. While other people are saying that the stock market is just going to continue to decline much further, especially as the Fed continues to increase interest rates. So in this video, I'm going to investigate whether the stock market is expensive or is it cheap enough for us to start buying? So as always, guys, smash that like button. It really helps. And subscribe if you're new. You're watching More Money. Let's get it. What's up, guys, and welcome back to the channel, where the mission here is to help at least 1,000 people achieve financial independence much sooner. And from the feedback that I'm getting from you guys, we are well on our way to achieving that goal. Now, what's interesting is that the market is now declining. Year to date, it's down almost 16%. And that's a really interesting time for value investors, because for people like myself who really sat on the sidelines last year while everyone else was making money, I was around 70% in cash. It was really hard to see that the market was up, everyone was participating, and I was largely sitting on the sidelines. From an emotional perspective, as an investor, frothy times are really tough. And so like I told you guys already, one of the things that I do is I try to take up other hobbies. So I tried to learn how to cook and smoke meats and all sorts of other stuff while the market was expensive. But now, as the market is getting cheaper, it's getting much more exciting, to the point where I'm spending way too much time sitting in this office and valuing companies. But that's what I love to do. Now, enough waffling. I do want to take you guys through the research. So you can see here that the S&P 500 is down 16% year to date. But what I want to point out is that the S&P 500 isn't necessarily the barometer of the market like it used to be in the past, especially when I first started investing. You can see here that over a fifth of the weighting of the S&P 500 is large technology names. And why does that matter? Because you can see that while the S&P is down 16%, note how the technology names are down more. And I put all the numbers here for you. So Apple is down almost 20%. Microsoft is in that 20% range. Amazon's down 35%. Alphabet's down 20%. Tesla's down close to 40%, and Meta's in that 40% range too. So you can see how these larger names are starting to take down the S&P in the technology space. And just to show it to you in a better way, this is what's called the Vanguard Information Technology Index Fund ETF. So if you wanted to invest in the technology space, this is a good ETF to do it. Not that I'm recommending you buy or sell any stock or ETF at all, but you notice here that it's actually down almost 25%. So you can see that the technology names have been driving down the market. And then, of course, the more speculative area of the market, which is largely what ARK Innovation generally types to invest in. And then, of course, the more speculative area, the genomics and emerging disruptive technology space that ARK Innovation tries to typically invest in, that's down almost 60%. Now, one of the interesting things that you might find is I'm a deep discount value investor. Kathy Woods is more of like a disruptive type investor. I personally actually really respect her, and I really think she's bang on the money with her thesis. The only area where we typically disagree is on valuation. I just couldn't get behind her on the valuations that she was paying for the names last year, and of course, the market is now down. Now, if you were to ask her, she thinks these things are very cheap, and she might be right over the long term. I just can't get behind paying exorbitant multiples for companies, which I admittedly may not necessarily understand as much as she does. Now, of course, just because the market is down doesn't necessarily mean it's cheap and it's time to buy it. What I think a lot of the people are doing who are on the news, who are saying that the market is now down and it's now a good time to buy, they're really just looking at the price action. They're not looking at what does it reflect necessarily. And I'm going to show you guys a couple of ways that you can do that. The first way actually is by looking at the Shiller PE ratio. So according to the Shiller PE ratio, the market still looks expensive despite the recent drop, as it's trading at 32 times on a price to earnings basis. Now, the one thing that you got to be aware of with the Shiller PE ratio, it's using a 10-year historical earnings average. So it is a trailing indicator. So if companies' earnings are starting to accelerate, and of course the current multiple is forward looking, it would reflect that. And so you might have a breakdown in this area, but you could also describe that as companies' earnings accelerations usually decelerate and come back down. And so the Shiller PE ratio might actually show you some information that a forward PE ratio may be missing, as estimates for future earnings are too high. So something to sort of think about when you start looking at forward PE ratios versus the Shiller PE ratio, etc. There's another metric that I do want to show to you guys. This is called the Buffett indicator. And guys, correct me in the comments if I'm wrong, but I think the Buffett indicator is the market capitalization of all publicly traded companies divided by GDP. Now, guys, please comment and correct me in the comments below if you're wrong. I'll pin the comment. But you can see here that from the Buffett indicator, last year when I was talking about this, I actually brought this up. I said that the market was really high relative to the Buffett indicator. I really like the Buffett indicator as a market gauge. And you can see now that that was kind of right on the money, even though a lot of people hated on that video and it was the most disliked video that I put out. I'm only just going to put out what I think is true and based on reasonable research. And if people don't like it, then at the end of the day, it doesn't really matter to me. I invest to make money, not friends, but I do make YouTube videos to make friends. But anyways, so you can see here, as of May 13, the 175% ratio of market value to GDP is 33% higher than the long-term trend line. It's putting it into that sort of like that 1 time standard deviation above what's considered fairly valued. So based on the Buffett indicator, the market still seems a little bit overvalued. So that's another data point, and that's probably a better data point than the Shiller PE ratio. So I think it's kind of saying, the market's still 1 standard deviation overvalued than what it's historically been. So take that as you may. Now, moving on, I did see an article in the Wall Street Journal that provided a very interesting data point. So you can see here, the title of the article is "Stocks Are Way Down, They're Still Expensive." So the Wall Street Journal is making the argument that stocks are still expensive. And so this is the data point that they pointed out. They're saying that even though the stock market has fallen 16% to start 2022, the S&P 500 traded this week at 17 times its projected earnings over the next 12 months, according to FactSet. But you can see here, that 17 times earnings is still above the average multiple of 15.7 over the past 20 years. But it is down from a recent peak of 24.1 as of September of 2022. So this metric once again says that the market has become cheaper, but it's still a little bit overvalued, just kind of like how the Buffett indicator is suggesting. And so I just made the point here that it's getting close, however, still remains above the 20-year average. However, a 16.8 times forward PE ratio isn't that bad. But I personally believe, and this is where we get into a little bit of the speculative territory, is that the market does have the potential to continue to decline further in the near term as the Federal Reserve continues to increase rates. Now, I do want to show you this, that the central bank's forecast for the federal funds rate is to reach 2.75% by 2023. I'm not sure that it'll go that high, but I do think that there'll be more rate increases, which will likely take the market lower. A combination of higher prices plus higher interest rates, I don't think is bullish for the economy. We'll see how this plays out. But the stock market might actually interpret this in a favorable light. So you might actually see rate increases get announced and the stock market surges because the risk of sort of like a hyperinflation becomes less and less likely. And so it alleviates the stresses of some investors. Now, of course, guys, when it comes to stock market valuations, I don't invest using high-level metrics. I actually am a ground-up type of investor. So I look at the specific companies and the specific valuations that I provide to the companies, and then I decide whether I'm going to buy them or sell them based on where they are valued as a percentage of their intrinsic value. So you can see here that of the companies that I'm following, 7 of the names are below half of their intrinsic value. And you can see Alibaba, no question there. The price is under $90 per share and its intrinsic value right now is $300 per share. But I did make a couple of videos where I said that I'm going to bring that intrinsic value down to around $250 maybe. And so we'll see where that lands once I redo the valuation after their Q4 press release. They've provided more disclosure now, so I can model out the company a little bit differently. I think I can model it out better now. But, it might be trading at around anywhere from 30 to 40% of its intrinsic value. So it's still cheap. It's still in that green category. You can see Zillow. I actually really like Zillow. So it's trading at half of its valuation. It's a name that I recently picked up for the portfolio. Alphabet, I really like this name. It's trading at around 60% of its intrinsic value. I don't know if Alphabet comes down even more, but I do have capital allocated to purchase Alphabet at $2,000 per share. I might get it, I might not. Facebook, you can see that it has come under $200 per share. I actually think that Facebook could drop further. So we'll see if we can pick that up at around $150 per share. And then here's a name that a lot of you guys in the value investing community are interested with. It's Ollie's Bargain Outlet. That one I'm sort of valuing at around $64 per share. So not that cheap yet. But overall, the whole point of what I'm trying to point out here is that I have fewer names that are in the buy zone for me than I do names that are outside of the buy zones here. So I got 7 names below half of their intrinsic value and 50 names that are sort of approaching half of their intrinsic value. So in terms of universe of securities that I'm following, I don't have a significant amount that I can purchase right now. Mind you, sometimes these guys go up and down. They're in that less than 50% category, and then they go out of that less than 50% category. Zillow is definitely doing that, and a couple of the other names that are blocked out here were doing that. And then, of course, in this schedule, you can see that the significant majority of the companies that I'm following, their share price is well above 75% of its intrinsic value. And I just unhighlighted a couple of them. H&R Block is one that I really love. Maybe it's because I'm a CPA and I own a tax company that I want to own H&R Block too as a shareholder. So maybe. But I also like Roku. I own a Roku. I believe in the product. So that one did come down to under 75% of its intrinsic value, but then it ran up again. So it didn't come low enough for me to buy. Microsoft is another one that I really love to buy. I don't think I'll ever get a chance to buy Microsoft. However, that Activision arbitrage opportunity might be the closest way that I can make some money off of Microsoft. But the point of this sheet is to show you that the significant majority of the names that I'm following are trading close to what I would consider their intrinsic value. And I valued all of these names myself. I have a valuation model that ties to every single one of these names. And so the way that you would access this if you're a Patreon is you see how the ticker symbol is in blue. You can actually go into the tracker, click on the ticker symbol, and it takes you right to the valuation model. And it's completely granular. It breaks out each year right down to the valuation. And then it generally will give you 2 valuations, an EPS valuation and a free cash flow per share valuation. Sometimes it'll give you an adjusted EPS or an adjusted free cash flow per share valuation. So you might get 4 valuations for one company. It just depends on what the situation looks like. And from a high level, I just made this to reiterate the point that of the 51 companies that I'm following, 13 of those companies are trading at 0 to 10 times their 1-year forward PE ratio. 14 companies are trading in between 10 and 15 times what I believe their 1-year forward PE ratio is. And then, of course, 24 companies are trading at 15 times what I believe their 1-year forward PE ratio is. So from this, you can see that 0 to 10 is dwarfed by the 10 plus. So, of course, based on this data, the market can decline further. But I do want to point out one caveat that me following 51 companies and valuing those 51 companies is not a barometer for the market as a whole, but just based on that data, it suggests that the market can decline further. So now I've given you guys 3 metrics that suggest that the market is a little bit overvalued, but it can decline further. So use that information as you wish. And of course, guys, you guys already know you can get access to all of the models and the data, but I also provide you guys with some additional secret stuff like cool research, option stuff, etc. that I don't really make public. And you can get access to all of that at $5 a month. And of course, you guys know that if you subscribe and you try it out in the first month and you don't like it, no problem. You get a full 100% refund. But the one thing that I really absolutely love about this Patreon so far is that our retention rate is actually greater than 100%. And the reason why that is because more people tend to upgrade to the call tier than people who end up canceling. And so what that really shows to me is that the value that's being provided here is significant. And I absolutely love it because I'm not really trying to make money here. So that's why I price it so low. I'm just trying to make your lives better and try to help you achieve financial independence much sooner. Now, with that said, one company that's going to be reporting very soon is Alibaba. Now, ahead of their Q4 earnings, I actually doubled down on my shares in Alibaba, and you can get to that video right here.